I'm endlessly fascinated and curious about the world around us, about business, about politics, about the arts, about culture, developments, social issues, and the people. Most importantly, about the people that are shaping our future. Every night, I get the opportunity to have conversations, to dive into conversations with thought leaders, with change makers, entrepreneurs, politicians, and everyday heroes who unpack the ideas and stories that I think matter to all of us. What's the future of our economy? What's the future of our country? How do we build stronger communities? What can we learn from music, theater, sports, politics, the arts? How does policy shape our real lives? What does leadership look like, real leadership in today's environment? If it's interesting and relevant and topical and we're talking about it, you'll hear about it here at 6 o'clock on the Brian Crombie Radio Hour. I want to have real conversations, in-depth conversations. These are ideas we're sharing. This is the Brian Crombie Radio Hour. Thanks for joining me. Good evening, everyone, and welcome to the Brian Crombie Radio Hour. I want to start tonight's conversation about the real estate business in Toronto by giving you a summary of the Toronto Real Estate Forum, which I was at just last week. I thought it was a fascinating closing panel that addressed the audience, a discussion that offered something we haven't heard much lately in the real estate business. Clarity. Not optimism exactly, but clarity about where we stand today and what's coming next. Across numerous different firms, Blackstone, KingSett, Choice Properties, Cadillac Fairview, and Oxford, the message was strikingly consistent. The market has stabilized, but it hasn't recovered. We are, as Blackstone's Janice Lynn said, bumping along the bottom. Borrowing costs have come down, but not enough. Transactions are happening again, but nowhere near pre-COVID levels. And with 2025 shaping up to be the biggest refinancing year since the pandemic, and 2026 potentially even more, not every borrower is going to make it through. Still, and this is what made the panel fascinating, was the people managing billions of dollars will all seem to agree on where the smart money is quietly positioning itself. So where is the capital going? 4 places. Retail, especially grocery-anchored retail. Data centers for all of that AI that we're using. Hotels, surprisingly, and land. Blackstone is doubling down on retail data centers, luxury hotels, and even select downtown office buildings, trading below replacement costs, they say. Why? Because these sectors have pricing power, operational resilience, and perhaps most importantly, regulatory clarity, something Canada doesn't always often. KingSett's Rob Kumar was even more direct in what may be the most replayed line from the whole conference. He said, buy land. It's hyper scary today, but in 2030 and 2031, it will look brilliant. Residential land, he said, is the cheapest he's ever seen. Construction costs are finally trending down, and industrial assets continue to deliver double-digit NOI growth. Choice Properties echoed that view. Immigration will rebound. Demand will return, and today's cap rates won't last. Oxford's Eric Plessman added a global perspective. He said, international capital is once again steadying high-quality office because the spread between debt costs and cap rates is compelling. Not just in Canada. Our regulatory drag, he warned, is keeping us out of the fastest-growing global asset class. Data centers. They're building in Arizona. They're building in Texas. Why aren't they building data centers close to our hydropower and nuclear power in Canada? Liquidity is returning, but foreign capital isn't. Where 8 months ago, a building might have attracted just one bid, today there are several, but almost all the bidders are Canadian still. Family offices, private capital, entrepreneurial investors. Cadillac's Fairview's Sal Iacono put it bluntly. Taxes, regulation, low productivity. Canada is full of impediments for global capital. Until these barriers fall, domestic buyers will continue to be the only ones setting prices. A surprising theme came up. The social fabric in Canada, in Canadian cities, is now a real estate risk factor. KingSett's Rob Kumar gave the panel its most sobering moment when he said, we own buildings and communities that are being torn apart at the seams. He cited anti-Semitism, crime, carjackings, not as headlines, but as operational realities affecting tenants and asset values, affecting where we, people, Canadians, want to live. Janice Lynn countered with the example of San Francisco. A city many wrote off just a few years ago has rebounded dramatically thanks to new political leadership, stronger policing, and revitalized retail. They used to lock all the retail goods away in pharmacies and grocery stores. That's changed because of political leadership. The message: politics and social stability matter, arguably a lot more than interest rates. And then multifamily, the sector everyone agrees on to dislike. Every panelist said the same thing. Multifamily is the strongest medium-term opportunity, but two barriers stand in the way: high interest costs, slow permitting, and infrastructure delays. Governments have made useful moves: GST relief, new CMHC programs, but the panel was unified. It isn't enough. Without faster approvals and investment in transit, water systems, and planning departments, we just can't meet population targets. As Icona said, if permitting and infrastructure aren't fixed, nothing else matters. The lesson from the last cycle and how to win in the next one. Panelists emphasized a kind of dignified humanity. Or really humility. We can't control interest rates, bond yields, cap rates, or geopolitics, but we can control operating fundamentals, leasing, tenant relationships, and the quality of what we build. During COVID, Cadillac Fairview's survival wasn't luck, Icona said. It was our relationships. So where does that leave us? The consensus was that capital markets are slowly improving. Valuations are stabilizing. Industrial remains a powerhouse. Retail is very resilient. Multifamily will be a major opportunity once policy aligns. And land at today's distressed pricing may be just the trade of the decade. Coomer said it best: the inflection point, it's behind us. We're not booming, far from it, but we're no longer failing and falling. And the people with long-term horizons are already positioning for what comes next. In 2025 and 2024, if they were the bottom, then the real question now is whether Canada can seize the upcycle ahead by fixing permitting, inviting global capital back, investing in infrastructure and making it work, i.e. the Eglinton Crosstown, and restoring social stability. Remember Rob Coomer's comment about social cohesion, that we don't have it. And we need it in our Canadian cities if people want to buy land, build homes, and live here. Because as the panel concluded, the industry handled the last cycle with resilience. Now it's time to position us and get government on board and the country on board for the next one. Thanks. We're going to take a break, and I'm going to come back with a very interesting conversation about one area in the condo business that is alive: luxury condos. Stick with us, everybody. Back in 2.